This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread. Today is episode number 49. Today's episode is titled, How to Find Money When Starting a Business. Now, if you're a movie fan like me, then no doubt you've seen the movie Jerry Maguire. In the movie Jerry Maguire, you have two all-star actors, Tom Cruise and Cuba Gooding Jr. And in this particular movie, you actually see them talking about money. You see, the sports agent, who's played by Tom Cruise, is persuaded by the pro athlete, who's played by Cuba, to, quote, show me the money. And in fact, there's a couple hilarious scenes where you have the pro athlete dancing and asking the sports agent to scream, show me the money. And it goes back and forth. And then there's a solemn scenes where he's like, dude, show me the money. And inevitably, that phrase, show me the money, came about because of the movie Jerry Maguire. Now, when we start a business, many times we're screaming, show me the money. We are. And truth be told, we can see that the good our product or service will provide to our potential customers. But we have to get the business off the ground first. And when it comes to starting a business, many times we need money to start a business. The good news is today we can start a business with very little capital. In fact, I looked in the internet world and I Googled business to start with no money, and I received over 330 million different results. There's a ton of businesses we can start without any money. That's true. I'll give you an example. My daughter, we started a small business for her, creating these things called bath bombs. Like a bomb would blow up, but they go in the bathtub. Her passion was she likes to make smelly little things like soaps and stuff. But she wanted to go on a mission trip this year, and being the mean daddy I am, I said, sweetheart, you can go, but I want you to pay your own way. And I'll help you, and your mama will help you, but we want you to start a little business and make your own money. Now, she's 13. You're like, dude, that's harsh. No, I want my daughter to learn what a business is. I want my kids to learn what a business is. So we started. But even in her making these little bombs that go in the bathtub to make your bath smell good, it cost us about $100 in startups. We had to buy some molds, these little round cups that I could press on and beat on, and she could press on and beat on to make compact ingredients. We had to buy some supplies. We even had to get her some business cards because she's doing a couple of fairs and trade shows. It just takes money sometimes to start a business. Now, you could start an internet business where you don't really need to spend money on a website, but you're going to have internet. Most of us do through our phones. But there are ways to start businesses with very, very little money. On the other hand, I work with clients who need millions of dollars to start up a business. They need money for equipment costs. They need money for employee costs, marketing costs. They just have to have a large amount of money to get started. So that leads me to the question, how can we raise money to start a business? Obviously, we can run down to the bank and ask for a loan. But as we discussed in episode 45 with our special banking guest, Mr. Jonathan Patrick, many times the bank is not our friends. And it's not typically the best choice whenever we're starting up a business. Oftentimes, they'll just say no. Now, sometimes the banker will be helpful and they'll say, hey, here's what I need you to do. But we have to be creative. We have to be a little bit renegade, if you will, as entrepreneurs. So I'm going to give you 12 ideas that you can use to raise capital to start a business. The first one is use a crowdfunding platform. Probably the most popular one is a company called Kickstarter. And there's a few others, but for the most part, Kickstarter came into the world, and it was an idea where inventors or entrepreneurs and the general public could establish a portal, if you will, that allows the population to see an idea. And if the idea was good or if the idea seemed helpful, then people could potentially invest in it. It became a fundraising platform. So you could go with a crowdfunding platform like Kickstarter. Another way to raise money is through the term angel investors. Now, Jonathan and I spent a little bit of time talking about angel investors, but we really never defined who they are. And I had a couple people say, Justin, can you explain a little bit more about angel investors? So angel investors stand out because they look for ways to invest in the next big idea. they're trying to find something that's going to hit it big. And so companies like Google or Yahoo were funded by angel investors. It's the most basic idea. It's basically an investor who's willing to invest in startups or entrepreneurs. Often the angel investor could be a family member or a friend. Basically, the capital is provided at either one time or is provided over a period of time to help the company get through the early difficult stages of starting a company. And the angel investor will often provide more favorable terms than other lenders, since they invest in an entrepreneur's business rather than the viability of the business. They're looking at the possibility of hitting it big. Okay, they focus strictly on startups. Now, the interesting thing is that angel investors, many times they must be regulated or registered with the Securities and Exchange Commission if they're true angel investors. But it's a way that you can go out and find individuals who want to invest in the big idea. Sometimes you'll have to give a little bit of share of your company to them, but many times they're not interested in that. They're just looking for a nice return on their investment, not actually investing in the company itself or owning equity in the company. But that leads us into the next phase, and these are called venture capitalists. This is the third place we can raise money. Similar to angel investors, venture capitalists have money to invest. They want to invest in young or up-and-coming businesses. The difference between an angel investor and a venture capitalist is venture capitalists typically want a share of equity in exchange for their investment. So probably the easiest way for me to describe what a venture capitalist is to point you to the show Shark Tank, which is on TV. And for those of you who've never seen this show, it's a TV show where individuals or business owners come and pitch or make a presentation to a group of rather wealthy investors. And these investors are called sharks for the TV show series. That's the word Shark Tank. And they'll come in and they'll say, hey, I have this idea, or I have this patent, or I have this business model. I'd like to give you 20% of my company or 40% of my company in exchange for $100,000 or $1 million, etc. And the sharks, the wealthy individuals in this particular episode, they offer a lot of really interesting advice if you just listen to them. And they are genuinely trying to help the person coming in. They offer sometimes some funny advice. Sometimes it's pretty shrewd. But nonetheless, they are venture capitalists in the fact that they want to give you money many times in exchange for some ownership of the company, or in exchange for some patents, or in exchange for a royalty. So that's venture capitalists. Contrast that with our second point, which was angel investors. They're really not interested in many times gaining ownership in the company. They just want a nice return on their money. So that gives us to our fourth point. Now, in our episode 45, Jonathan Patrick did mention the Small Business Association. And the Small Business Association is the U.S. government's vested interest in helping grow small businesses and helping small businesses succeed. So the SBA is how we say it in the business world. We just abbreviate Small Business Association to SBA. The SBA will often loan money to small businesses. Now, there's a couple of different types of small business loans. Many times they're underwritten through a bank, or you'll go to, your local bank on the corner or your banker, and they will actually underwrite the loan through the Small Business Association. So that's a way you can go about getting money for your startup. You can actually work through a local bank, and then they'll just use the SBA. In our small town in Knoxville, I say it's a small town. It's probably in the greater area, just over 1 million people, but it really is just a really small town. It's really small. Yeah, once you know somebody, you know them all. But in our small town, there's about 6 or 7 local banks that do a lot of business through the Small Business Association. If you know these banks and the bankers who are experts in this area, then many times you can go and get an SBA loan that a traditional bank will not loan money on. So it's just a way that you can work. Now, the SBA also has grants that are available. Many times we don't talk about those, and those are typically for not-for-profit or for educational institutions. So we actually helped a not-for-profit one time years ago when the firm I was previously with get started, and we used an SBA grant. So that's just a way you can go and raise money. A fifth way you can raise money is through what's called microloans. Typically, these are for not-for-profit organizations. Microloans are granted by institutions to individuals who typically don't qualify for the traditional bank loans. We have a consultant that works with our company on some client projects, and he and I were talking about a particular not-for-profit he's consulting in, and we were talking about microloans and how microloans will help this small, or actually it's a very large not-for-profit. It'd be a name that we all would recognize. So microloans are typically good for not-for-profit. So if you're looking in the not-for-profit space, maybe you have a philanthropic desire that you can create a business from that's a not-for-profit, then microloans may be the way you want to look. Now, number 6 is probably my favorite. Number 6 as far as getting capital to start a business, and that is personal financing. I personally believe the more skin you have in the game, the more driven you'll be to see it succeed. It's just the way I am. Now, there are some individuals who believe that you should use only other people's money, which is not a bad way to go about it. It's using other people's money to make money. I like that idea too. But one avenue we have to look at on how to fund a business is using our own capital. There's a number of ways you can do this. You can use a second mortgage. You can use a home equity line of credit. You can borrow money from life insurance policies if you happen to have those, like the old whole life or the universal life policies. You could even use qualified monies like retirement accounts if it's properly designed to help start up a business. And there's some pros and cons to all those different scenarios. I prefer not to use retirement accounts. I really don't like that idea. I think retirement accounts are for retirement, not for business. But there are ways that you can use monies in your personal side to help start up your business. And you can do it in an advantageous way. You can use your own money in a way that will help you long term.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
So number 7, the 7th way we can get cash to help start a business is using what's called purchase order financing. And what purchase order financing does is it's using like seasonality and supply and demand type scenarios. Let me give you an illustration of a client that I used to work with. He and his wife since have passed away, but this was a fun time. As you know, based on the tractor that you see on the Financially Simple marquees here and there, I'm just an old country boy, and I love my tractor. And I like working with good old-fashioned red-blooded Americans who just know how to hunt and fish and get out and tear some dirt up with a tractor and just have fun. And I worked with this old farmer years ago. I was probably 4 years into the business, and this guy was in his late 70s at the time. And we were doing some estate planning. And as part of his estate plan, we were dealing with how he ran his business. What he would do is he would use purchase order financing, to fund his crops. So here's how it would work. He would calculate the yield of his crops that he was going to plant. So for non-farmers, you typically don't plant the same crop in the same field every year. It's called crop rotation. You may plant corn in a field one year, soybean the next year, tobacco the next year, and you rotate. Now there's some sciences behind that, but so what he would do is he would calculate the amount of yield he would get out of his crops that year based on the acreage, based on the amount of sowing, based on the fertilization of the soil, etc. And once he knew the yield, so how many tons of corn he would get, let's say, he would then look at the price of the market at his particular point, and he would go ahead and pre-sell his crops. It's almost like a future, like a corn future is really what it was. But he would pre-sell his crops before he ever planted it. So then once he pre-sold the crops, he would go to the financing lender and borrow the money to actually plant the crops. Now, he didn't use 100%, borrowing money 100% to go in and, so let's say he was going to get $1 million for his crop. He wouldn't borrow $1 million. He'd borrow maybe $300,000-$400,000 of it, just enough to help him on his cash flow. And he was taking the difference and pocketing it and using it to build his net worth on the other side, called leverage or arbitrage. So he would calculate the amount that he could sell it for, go ahead and sell it, then go borrow the amount of money he wanted to finance. Then whenever the crop came to maturity, they harvested the crop, the buyer would pay him, and he'd turn around and repay the loan. And he'd repeat it year after year. So that's an example of what's called purchase order financing. So let's say that you have a particular product that you're trying to get to market. You may go out and go ahead and pre-sell it. And before you ever manufacture the product, pre-sell it, use your orders, your purchase orders, to go in and finance now the way to bring that product to market. There's another way that you can use, and that's called vendor financing. Vendor financing is where the vendor, somebody who's supplying you with a good or a service or a piece of equipment, they'll actually finance the product or the service with typically like a no payments for 30 days. Or no interest for 30 days, no fees, no late penalties, etc. Sometimes you can even negotiate where you'll go out 45 days from the time that you receive the product. So we use vendor financing in startups many times. Typically, we'll use them like in a supply type business. So I'm thinking of a client we work with that's an auto garage. And we'll go in and we'll stock up the oil, we'll stock up the air filters, the oil filters, the grease, the various lube, the supplies. We'll make a stock of it. We'll utilize those products, and then we'll pay the vendor after we've already used the products. That's a very simplistic way of vendor financing. Another way that we'll use vendor financing is like whenever we're working with entrepreneur doctors. So we work with a lot of dentists and chiropractors and optometrists and a lot of doctors who are not employees of an organization or a hospital. And many times these pieces of equipment that they need to run their offices can be extremely expensive. So, for example, I was working with a dentist just the other day, and one dental chair, like the chair you sit down in, this was a $75,000 chair. I mean, you're talking about there's cars that are less expensive than this, nice luxury cars. This chair is $75,000. Well, the vendor would do a 1 year same as cash, no interest. And based on the cash flow of the practice, we decided instead of going down to the bank or instead of pulling money out of their finances, we would use the vendor financing to help supply this particular piece of equipment. So that's another way you can go about raising money for a startup. You obviously, number 9, can go to family and friends. You can. Now, me personally, I am not a fan of this. I am not a fan of borrowing money from family or friends, but it's an option. I know people who have. I know families who have been successful in this matter, and I know families that have been destroyed over borrowing money. The way I look at borrowing money from friends or family is this, and this is a biblical phrase. Oftentimes it's pulled out of context, but the Bible says that the borrower is slave to the lender. Now, back in the biblical times, you were literally enslaved. It was called a debtor's servant. If you borrowed money from somebody and you refused to pay them back, you became an indentured servant for that individual, and you had to work off your load. We're not necessarily physically slaves today, but you can put the relationship into a enslaving scenario. I have seen people who borrow money from a mom or a dad or a kid, and all of a sudden they need that money back because the bank wouldn't loan them money. They need the money back, and the borrower doesn't have it. And so not only have you put your finances at risk, you've also put your relationship at risk. Friends, I'm not one who recommends, and in fact, I could have clients line up and say, yep, Justin will tell you that he's told us not to borrow money from our dad, not to borrow money from our kids. And you're like, Justin, have you ever borrowed money from mom and dad? No, I haven't. I know people who have, and not knocking it, and I know people who've done it and just fine, the relationships are just fine. But for every one person I can tell you whose relationship is salvaged, the borrower is slave to the lender. The last thing I want is my mom, my late dad, my brother, my sister, my father-in-law, friends or family, whoever, saying, we loaned Justin some money and he never paid us back. I just don't want that. So that is a way you can go about. I'm not a big fan of that. It's just my personal opinion. And if a client asks me about it, I'm going to give them the same answer I just gave you, that I just don't recommend it. Now, there's a 10th one that we can use, and that is to use contest. So I actually participated as a judge in one of these. And if you keep your ears to the ground, you can find these. In fact, you can Google it. In fact, we were talking about doing one of these for Financially Simple. And in fact, if you were listening to this, shoot me an email, justin@financiallysimple.com. Shoot me something on Twitter or whatever, and let me know what your thoughts on this would be. I'd be interested in knowing. We've been kicking around in our office whether or not we should have a contest. We have a lot of business owners who need help. And the way the contest typically works, and this is the way we would do it, is you would have some sort of an eligibility requirement. So you would have to be, let's say, a business owner or a startup, or you'd have to have a business going. And you would have to have some sort of a revenue increase. You may say, look, we're trying to increase our revenue at 30%. We're trying to grow our company, double it in 5 years, whatever it is. There's typically an entry fee. So someone may pay $100 or they may pay $500. The one I was a part of, there was a $200 entry fee. And so the participants, we had requirements. So they had to be in business for at least 5 years. They had to have a defined business plan. They had to know exactly where they wanted their business to be in 5 years from now. We had to have a step-by-step approach on how to get to that. And then we would look at the contestants and we would judge them based on the criteria that was set forth. And whoever won the event, they received a $25,000 cash prize. I have seen where contests can be used to start a business. I actually know people who've done this. So keep your ear to the ground. You may find where there's a contest out and about somewhere in your locale that you can enter in. Maybe your business plan that we had talked about a little while ago. You can enter in your business plan and perhaps win the seed capital, the money that you need to get started. So contests, don't rule them out. It could be very good. And on that note, if you think that that'd be something you'd like to see Financially Simple do, shoot me an email. Say, hey, Justin, man, that's a great idea. I'd like to see something. Or if you had some insight on that, please share it with me. I'm open to that one. Another thing you can do, and we're getting to the end here, rule number 11, you could do product pre-sales. So if you're selling a single product, a good way to raise money is you go ahead and pre-sell that single product before you ever make it. So that's very, very, very similar to vendor financing, and it's very similar to purchase order financing. Very similar, but it's not the same. Many times you'll have a warehouse full of goods. You typically see this like on Alibaba, where someone goes to Alibaba and they'll buy like 100 coolers. And they'll go to Amazon and they'll publish those 100 coolers. Think of it in reverse. You have somebody who now wants to buy 100 coolers. So now you've pre-sold it before you ever outlay the cash for your profit. You pre-sold the product. Now you're going to go buy it from Alibaba and get it printed with their logo, etc., and then send it over to the customer. That's a pre-sale scenario. Now your danger with that is that what if the customer demands money back? That could lead to problems in the pre-sale. So that could be a little intimidating. You'd have to work out all the different issues there, but it's another way to raise money. Now, the last one is just alternative lending sources. So there are what's called alternative lenders. So the ones that are probably the most popular that I'm aware of is companies like PayPal or Cabbage. It's spelled with a K, by the way. I double-checked that. Cabbage is spelled with a K. A company called Prosper. And these are just small lenders who are outside the banks, who are outside the government agencies, who are typically doing lending on a case-by-case scenario. And they're called alternative lenders. They're typically going to have a little higher interest rates. But that's another way to raise money for your lending sources. Now, obviously, we can go in and you can use credit cards. But, friends, I'm not a fan of using credit cards to start a business. Because if the business goes defunct, you're now left paying 25, 30% interest on a credit card. I mean, it gets really high. I'm not a fan of that. So there are 12 ways that you can use to start a business. You can get creative. You don't have to have a lot of money. You don't have to run down to the bank and borrow everything. There are a number of ways to raise money. And with that, I'd like to thank you for joining me on the Financially Simple podcast today. As always, the show notes and the links to today's podcast are going to be found at financiallysimple.com. And while you're there on the blog, feel free to sign up for our weekly newsletter. Every week I release tax tips, business tips, wealth management tips. Some of my best writing goes out in that particular newsletter. Now, in our next episode, we're going to be talking about the basic systems that you need to implement in your business. Things like accounting, things like KPIs, just various operational flows. So we're going to talk about the basic systems that you need to have implemented in your startup. And if you like the show, please subscribe, share the podcast with other business owners. Like I say every week, folks, life is hard. Life is good, and life can be frustrating. We know that. Money doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and create an outstanding day today.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.